Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 28th of March, 2023. And as you can see, it's a bit of a different background here. Today's show, we have a little special coming to you live from Nicaragua. It's been a nice place to be after the Fed came out last week. And that's going to be the topic of our show today. We're going to dive into what the Fed said, what the next step is for the Fed, and most of all, how this will affect your money going forward. All that more coming up right now on Making Money. If you're holding out hope for a bull market, then please pay close attention. According to legendary investor Mark Chaikin, who Jim Cramer famously said he never bet against, you need to prepare for the next wave of volatility to hit U.S. stocks. Mark's prediction is based on an indicator that has only triggered a handful of times in the last 72 years, with a 100% success rate predicting where stocks will go next. Now, the man who's just spotted it is sounding the alarm. During Mark's 50-year career, he's worked alongside some of the biggest investors in history, including Paul Tudor Jones and Michael Steinhardt. In fact, Mark invented one of Wall Street's most popular indicators for picking stocks, still used by hedge funds, banks, and brokerage sites, and today found in every Bloomberg terminal on the planet. Now, Mark's inviting you to join him as he explains exactly what the next wave of volatility will look like and where it will send stocks in the coming months. He's even sharing one of his favorite ideas free for those who tune in. He says this idea could create bigger gains than anything he's used his power gauge system for until now, by turning the coming market volatility to your advantage. And you don't have to wait until March 28th to get started. For a sneak peek on Mark's big reveal, go to ChaikinEvent2023.com. That's ChaikinEvent2023.com. Once again, this is Matt McCall. Thanks for joining me here at Making Money. As I mentioned, a little bit of a different location here this week, down at my second home, if you will, in Nicaragua. And got the beautiful painting behind us like we normally do. I will, though, apologize for the bit of a voice because this air conditioning down here really gets to me. And the fact I need a haircut. But other than that, what's most important about this show is we're going to dive into what the Fed really did last week, or didn't do, if you will, how the market reacted, how Janet Yellen, Treasury Secretary, what she's been saying recently, wrap this all together with what's going on in the banking system and come up with a plan going forward. And some people say, well, Matt, it's just the Fed. The Fed doesn't really know what they're doing anyway. They were behind the curve when inflation started taking off. They were too late. Then they went bananas and had the fastest series of rate hikes in the history of the Fed. And now people believe that they're raising too much, even though inflation is consistently coming down from the highs from the middle of last year. So people say, well, why does it matter what the Fed says? Well, because as the Fed goes, so goes stocks. Because even though we may not agree with what the Fed's doing, we may not believe that they have as much power as they should. At the end of the day, they do. They control the money supply, and they control really the markets, in my opinion, because by controlling inflation, attempting to control inflation, put that out there, by controlling interest rates, it directly has an effect on investors, especially big money, on which asset classes they'll be buying, if anything. So I got a bunch of charts we're going to go through here. But first thing I want to take a look at is kind of what happened last week. And this was obviously on March 22nd, last Wednesday. So nearly 1 week ago when the decision came out. You know, he came out, Jerome Powell, the Fed chairman, came out that day. He had a press conference after they announced that they were raising interest rates by 25 basis points. Keep in mind, just 2 weeks prior, the odds on favor were 50 basis points. And we had obviously Silicon Valley Bank. We had Signature Bank, and then the potential of a banking crisis and the contagion fears were out of control. And at one point, they thought that the Fed would actually pause. I believe Goldman Sachs and a few others did go into the meeting thinking that the Fed would do nothing. That I thought they should have done nothing, but I did believe that they were going to 25, which is what they did. He did come out, though, Chairman Powell, and he assured that markets and the banking system were resilient and strong. But he also made a point, though, too, saying that depositors are and would be safe. So let me dive into that because that's important. What that means is depositors, you and I, he didn't put a certain amount of number on it. Right now the FDIC insurance is up to $250,000 in cash in your banking institution. So above and beyond that, if the bank were to fail, essentially you should lose anything above that unless there's some type of other insurance on top of it. Well, he basically came out, Chairman Powell, and said that all these deposits are safe. So that's big. Then we have Treasury Secretary Janet Yellen. She came out earlier last week before the Fed meeting and basically said the same thing, that the government will backstop any other runs on the bank or any other Silicon Valley or Signature Bank situation. Well, then she came out Wednesday afternoon after Powell got done speaking and the market was up. She came out and said basically everything the exact opposite of what she said a couple of days prior, that she was not reassuring that banking sector. And even though Powell came out and said they would in no specific terms, even though Janet Yellen said they would, basically in specific terms, 2 days prior, she came out and switched her tone. Well, the market got crushed after that on Wednesday afternoon. But then, of course, Janet Yellen came back out the next day on Thursday, and she said that that federal emergency actions that were used to backstop Silicon Valley Bank and Signature Bank would be used again if necessary. So my point of all this is, and I could dive into it more, but there's no need. I think you get the point. The point here is that we have the Fed, we have a government representative in Janet Yellen from the Treasury Secretary. One person alone, her alone, doing the old back and forth, the old zigzag. One day we got the banks, one day we don't. One day we got the banks. Powell saying that they do. So that unknown, that really kind of no man's land, if you will, has really pushed the market lower and really kept it from breaking out. And since that time, I'm going to show you a chart here in a minute of how some asset classes, including stocks, have done. And the big takeaway we're going to see here is that really stocks were doing pretty well. And the NASDAQ was not far from breaking out to a high before this happened. So here's a chart right now. This is going back to March 21st. So this is the close of the day before the Fed meeting, or before the Fed announcement. As you can see in that time frame, emerging markets, believe it or not, as tracked by EEM, which is an ETF that tracks emerging markets, from that time heading into Tuesday. So basically, you're looking at last Tuesday's close into the Monday's close here of this week, up 2%. Gold has held up pretty well, up 1.2%. Then you see the 20-year bond is up down 0.6%. Bonds down, it means yields are up a little bit. When yields go up, your bond prices go down. We have the S&P 500 down nearly 1% heading into today. We have the Russell 2000 small mid cap down over 1.5%. And then we have Bitcoin down 2.7%. It was holding up really well just until the last 24 hours. But let me show you again, these are the asset classes since prior to what the Fed said. So we're just trying to get, it's only 1 week to understand, but in that week's time frame, it's really not much direction at all. But let's take a look here at what has happened since the beginning of the year in the exact same asset classes. And as you can see, there's one clear winner here, and that is Bitcoin, up about 63.3%. The next best would be gold, around 7.5%. Then we go down with the Treasury bond, TLT, up 4.8%. We have the spiders, the S&P 500, up about 3.4%. So even though we had a great start to the year, the market's only up 3.4%. Emerging markets up 2.4%, but it's really come on as of late. And then we have the Russell 2000 small mid cap actually down for the year again, which was up pretty big. It was up double digits at one point in early February, and now we are down here for the year. I want to show you that because I want to show you the reaction that we had from stocks in the last 5 days. And just, of course, much longer term investors, we're still not looking at 3 full months, but we are nearly closing out the month here, which is maybe a good sign. Get the first quarter behind us, move forward. I said that in 2022 as well, get that behind us and move forward. But we'll show you a couple more charts here in a moment, but a little bit more back to the Fed before we wrap up that angle. Just to give you an idea of what Janet Yellen did say last Thursday. So basically her most recent comments that are really out there. This was one of her quotes. She said, "We have used important tools to act quickly to prevent contagion, and they are tools we could use again." That was in a written statement that she said in testimony to his House Appropriations Subcommittee. She also went on to say, the strong actions we have taken ensure that America's deposits are safe. Certainly, we would be prepared to take additional actions if warranted. And is it the old too big to fail, 08, 09, where, if you're a big bank and you have the potential to create contagion and create an actual banking crisis, the Fed, the FDIC, the government was going to back you up? Maybe. Or will it be smaller banks out there because we want people to be assured that their deposits are safe in a U.S. bank? I think it's really both. I think it's going to be a little bit of both, and I think it will be tackled on a as-is basis. But I think at this point, there's no reason to believe, in my opinion, that if any bank is about to fail, that they will put together some type of plan to assure the depositors are made whole, just as they did in Signature Bank, just as they did in Silicon Valley Bank. So now that this is out, that we've had the Fed come out 25 basis points, kind of got that behind us. Just to give you an idea, the next Fed meeting is not until May 2nd and 3rd, and there's one in June after that. So there's nothing in April. But it's only about 6 weeks in between the two. But the latest in economic projections from the Fed themselves that they put out last week, they revised their overall growth expansion numbers lower. They now expect that the economy will grow 0.4% for the year, 0.4%. That's not much growth. So that's like borderline recession right there, folks. And just another kind of fascinating stat I saw here. JP Morgan reported that retail traders sold $1.4 billion worth of single stocks over the past week. And that's because people are turning away from fixed income, turn to fixed income. And believe it or not, they went in some big tech stocks as well, but there's some single stock selling going on. Outside of the Fed chairman itself, Jerome Powell, there's another, there's also Fed presidents all around. And Bullard, B-U-L-L-A-R-D, is Fed President Bullard. He came out on Friday. He tends to be one of the most hawkish, means most aggressive out there. He came out and said that financial stress will abate and that the Fed will need to go back to being aggressive based on stronger economy and sticky inflation. So he raised the upper end of the target of what he is. Right now, the target's 4.75 to 5. So it comes in about 4.83, the Fed funds rate. The Fed's target's 5 to 5.25, which would be 5.125, which would be 25 basis points from here. So basically, the Fed is pricing in one more 25 basis point hike. Most likely not in May, maybe June. We'll see how it goes. But Bullard has his at 5.5 to 5.75. So he's pricing, and he's not even a voting member right now. So it doesn't even matter. He's not even voting, but he loves to hear himself talk, along with a lot of other Fed presidents. Love to hear himself talk. His range is 5.5 to 5.75, which means, in his mind, another 75 basis points, another 0.75% in interest rate hikes, where again, the Fed is only looking for 25 basis points. But he also did come out and say that the bank stress will actually be helped by falling yields, but he's talking about raising yields. Some of these presidents tend to talk out of both sides of their mouth pretty often. He also came and said that the financial stress can be, quote unquote, harrowing, but eventually it lowers interest rates and it's good for the economy. And he went and talked about a couple other situations over the last 4 decades that situations in banking crises that really helped eventually lower rates and built the system stronger going forward. I don't disagree with that. That being said, I just talking on both sides of his mouth, so I could care less really what he says, but I want to put it out there because the markets do tend to move on what Fed President Bullard does say. Since the kind of banking crisis here began, the 10-year yield on the 10-year has fallen about 50 basis points. The 2-year fell as much as 100 basis points. So we've seen naturally, just from what's happened, interest rates come down already. And that's more natural than the Fed pumping them up or pushing them back probably at the end of this year. So keep that in mind. Now, the market tends to really track what's going on, and a lot of times will really go into equilibrium on itself. So now, looking ahead to the May meeting, there's now about a 65% chance that the Fed will do nothing, stay where they are. And obviously, on the other side, that is about a 35% chance, give or take, that there'll be a 25 basis point hike. We jump ahead to June's meeting. There's about a 57.5% chance they stay flat. So there's over 50% chance for the next several months that the Fed will do nothing. I have no idea. It's a little bit early to say what, but if I had to give an educated guess, I'd say in May, They do nothing. June, I can't even look out that far right now. But I think in May that we would be good to do nothing. Again, I don't want to jump out that far only because so much can happen between now and then. And now let me show you a chart here really quick. This is the effective Fed funds rate. You can see it's at 4.83%. That's because it's between 4.75 and 5. So it's kind of in that middle, which really it should be a little bit higher if you think about it, if it's actually split directly in the middle. But you get the point. And you can see how quickly it's come up since really the first quarter of 2022 on the bottom of the chart there. I just want to give you an idea where we stand historically over the last several years. You know, there's a stat that's been going around. I wrote about it in Monday's daily email that goes out every day the market's open. I put together a daily email. And this is from the Bank of America Global Investment Strategy survey they do of fund managers. And they look at the money market fund assets. Right now, we just hit a record $5.1 trillion sitting in money markets. You can see here in a chart, this goes back to 07. It spiked in 07, 08, topped out in 09. You know what happened then? That was a banking crisis. So money market people took money out of equities, took money out of everything, and put it into money markets, which are deemed to be pretty damn safe. And as you can see, that number peaked in about the first quarter of 2009. You know what happened in the bottom of 2009, March 2009? Probably one of the greatest buying opportunities of a generation. We saw stocks soar from there. We saw money market assets, as you can see in this chart, fall and then really go sideways for about 7 years, really 2012 through 2019-ish, started taking off again. And then we really took off in early 2020. You know what that was? It was not the crisis. It was the pandemic. It was COVID. And then since that time, it pulled back and was going sideways. And now we're having another, I wouldn't call it a banking crisis, but we're having a major banking issue right now. You can see in the chart, it's spiked back up to $5.1 trillion. It's a record high in money markets. So what does this mean, folks? This means a few different things. For one, it means that there's a lot of money sitting on the quote unquote sidelines. Money markets still are not paying very high interest rates. So it's not like you're saying they're getting huge yields coming in. So the way I view this is that money, just like in 09, just like in 2020, there'll come a point, there will be a catalyst to drive that money back in equities, and it will result in a huge rally. Because post 09, huge rally in stocks. Post 2020, COVID, huge rally in stocks. We both know that happened. If you didn't live through them, I definitely lived through 2020. So that is a chart that I thought was really important. We need to show. And here's kind of a follow-up on it from the same survey. You can see here, this shows investors that are most overweight cash and most underweight U.S. equities. So this is the absolute net percentage of overweight. And as you can see, cash, overweight, look how high that is. And that in emerging market equities, which is pretty interesting. I showed you how they've held up pretty well recently. But look at what the most underweighted is by far, U.S. equities. Folks, this does not stay like this forever. And the only way for this to change, money come out of cash and money go into U.S. equities. I'm not saying it happens tomorrow or next week. Could we have continued chop for a month or two, some more months? Yes. But at some point, there will be that catalyst where the money will come out of cash and go back into equities. And U.S. equities, the way they're positioned, look pretty damn good. And I got one more chart here for you. This is from Ryan Dietrich over at Carson. And this is pretty interesting. This goes back to 1950. And it shows that when the S&P during the first quarter of a new year, obviously, the low of that first quarter stays above the December low, which we're about to close out the quarter, and that will be the case as of now, unless something dramatically happens, but that will be the case. And that means you look ahead for the full return on the S&P 500. And it's happened many times, as you can see, going back to 1950. And the market's positive 94.4% of the time. So basically, 2 times in there was not. And the 2 times it was not, it was basically zero, but it was fractionally lower. And that was in 2011. And then 2015, down 0.7%. So it's never been down more than 0.7%, and is up 94.4% of the time. Average gain 18.6%, median gain 18.1%. Again, stats can be twisted and turned in all different ways. But my point is, you look at this and it's tough to ignore it. The other thing I want you to look at here really quick too is, let's go back to the year I was born, 1976. You see what the Q1 low was on the S&P 500? 90. You know what the Q1 low this year was? 3,808. Just think about that. Think about that. You know, from my time I was born until then, how much the market's gone up. And think about all the stuff that I had to deal with in the last 47 years. How much I had to deal with. And it's still so much higher. So what we're dealing with here today, folks, there's a lot going on. Geopolitically, politically, financially, what's going on with the governments as far as governments tied to money, taxes, I mean, you name it. There's all kinds of stuff going on, social unrest around the world. And the bottom line, though, is that we've dealt with in the past and look at those gains. So, you know, my view right here is that we continue to hold up and look really good overall in the markets, even though we've gone sideways here for quite a bit. I do think there is a lot of upside potential. Do I think we go straight up from here? No. But I think as an investor, and whether it's equities or Bitcoin or anything else, you want to be consistently buying, dollar cost averaging, not necessarily the same investment, but into the market, because at some point it's going to move fast to the upside. Keep in mind, we've held above these October lows for a long time now. And it doesn't look like there's anything indicating to me that we're going to go back down and test them. So that being said, I think the bottom's in for that year-long or so bear market. And I think that we're setting up for a really nice stock market return in the years ahead. So thank you so much for watching. Coming up Thursday, speaking of emerging markets, we have a great interview. We have Brendan Ahern from Crane Shares. He's the chief investment officer over there. You may know him from the Stansberry universe. We've had him at conferences in the past. I've spoke with him in China before. One of the most intelligent investors here based in the States on investing in China and emerging markets. He'll break down some areas he likes over there, which is be very interesting considering how well emerging markets have held up as of late. Is there a great opportunity over there? He'll break that down for us. And then next week, we'll be back in our studios in Florida. So again, thank you so much for bearing with what we're doing here in Nicaragua. Make sure you tune in Thursday for a great interview with Brendan Ahern. And then again, Tuesday, we'll be back in the normal studio. Thank you so much for watching. It's been a pleasure. Once again, that's Making Money, and I'm McCall.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.